So on behalf of the African Agri Council, welcome to today's session on AgriFood-TECH investing, where we'll be speaking with 6 investors about trends, available capital, and their investing criteria when evaluating opportunities in the space. My name is Martin Slawek, and I'll be moderating the session. A quick note on session format and housekeeping. We'll be speaking with 2 sets of 3 investors over the next hour, with an opportunity for Q&A at the end of each group. The way the Q&A will work is please type your questions as you did for the last session on the right hand where it says chat, and please put the word question in all caps just so we can quickly identify the question when the time comes. And if you do have a specific question addressed to a person, please do sure to make it known. Well, we'll try to make room for as many questions as we can. We may not be able to get to all of them, but please feel free to connect with our investors during the networking event after this session. The speakers will also be given a transcript of the chat so they can reach out with any additional clarifications or questions after the event. Great. So a quick personal intro before we get started is, I'm Martin Slawek. I'm a senior project leader at Open Capital in Nairobi, Kenya, which is a management consulting and financial advisory firm with offices in Kenya, Uganda, Zambia, and Nigeria. And over the last 10 years, we've worked across 20 countries in sub-Saharan Africa and executed over 600 advisory engagements across different sectors and raised over 600 million USD in capital for investors and businesses. We often advise agribusinesses and public and private investors to provide pre and post-investment support, develop pipeline, and raise capital for businesses. Much of the work we've done is focused on agricultural sector and or in rural economies, and increasing amount of interest we're seeing from clients and partners in regards to technology and digitization efforts in this space, which is why I'm so excited to moderate today's panel of highly experienced investors in this space. Before I do let our investors speak more about their firms and opportunities they're seeing in agri-food technology companies, do think it's important to quickly contextualize investment in this space. I think we all recognize that the space is really large and it means different things to different actors and investors. And globally, as of 2018, there's over 17 billion USD investment to agri-food tech companies globally, according to Louisa's organization AgVentures. And much more across traditional companies, leveraging technology to strengthen the food supply writ large. And while most of that is dispersed globally, there's an increasing amount of, either technology-based ag companies or traditional agriculture and food supply chain companies using technology to optimize their operations across some of the countries that our speakers are coming from today, including Kenya, South Africa, Nigeria, Ghana, and India. And while a lot of investors are interested in the space, ranging all the way from purely commercially anchored investors to more impact investment-oriented investors, there's a wide range of return and impact expectations in between. And it is important to recognize that different investors have different time horizons, capital tools at their disposal, and return expectations. And that visibility and understanding among businesses and investors often increases the likelihood of landing the right match between an investor and a business. Just before digging into kind of how your firms individually identify and evaluate these opportunities, David, Roger, Mezuo, would love to hear your big picture perspectives on any recent trends or developments you've seen in the space from the investor lens. Whether it's the rise of interest in AgTech and food tech over the last few years, about the investability in these companies, or any changes you've seen, how investors have engaged the space broadly, or even more relevant in the time of COVID now, right? Just in terms of appetite. Roger, just heads up, we do hear you speaking. Not hear you. There we go.
Some very good friends there.
Yeah, hello everybody. Is this better?
Oh, we're looking forward.
Yes, thank you.
With a man named Bill Stanley.
So,
brother Jim.
hi, just to pick up on some initial comments, Martin, I find it's critically important to really think about how the analog and digital are merging.
Roger, you're cutting out just for a moment there, unfortunately, with your microphone.
is making sure that the digital and the analog are being merged. Too often, people love the digital solution without understanding the analog of what's actually happening on the ground.
Completely agree. I think, you know, a lot more models that we've been seeing coming into the space, right, is people are recognizing that need and tension, right? And I think that, you know, in terms of businesses recognizing that, but also in terms of investors recognizing that there's this need to push businesses in that mutual understanding between both analog and the digital.
Martin, perhaps if I can build on Roger's comment.
Of course, Mezuo, please.
Yeah. So to give context, we're active in Nigeria. We are more growth capital than early stage, and we invest in a range of businesses, more bricks and mortar than tech. And if you sort of frame the context in Nigeria, a lot of the challenges are around the appropriate inputs that many farmers would use, as well as logistics and supply chain challenges. Now, for the companies that we invest in and the link to AgTech and sort of the bridge between digital and analog, tech is very interesting for us just to see how can we use that to improve or address issues that our portfolio companies face. And is there any solution that is attractive, gaining scale, that could also potentially be an interesting opportunity for us? So for many of our companies, especially during this time, so first of all, supply chain is very tough. How do you get your crop raw materials to your plant and then end products to customers? So it's always a challenge in a regular year. Right now with COVID, those supply chain challenges are even more pronounced, and we're seeing lots of raw material prices going through the roof, which makes it also more difficult for our companies to operate. But we found that some partnerships there are a number of companies we stay close to around supply chain. So in terms of bigger known names, companies like Cellulant, which do a combination of payment systems and supply chain efficiency, and seeing how do we work with companies like that to remove bottlenecks around the supply chains we face in some of our companies. We've also stayed close to companies like Lorry and Kobo 360. So for us, it's, are there real world solutions that some of this tech we can use to address at our companies? And even for earlier stage solutions, we're always open as well to see how can we trial these solutions within our companies. And if there's anything that looks like it can get scale, then it becomes even more interesting for our fund.
Certainly. So Mezuo, from what I'm hearing from you, right, it's also, you know, partnering with some of these other enabling actors, right? Someone like Lorry is more in terms of distribution, right? And some of these supply chain partnerships to actually get some of the product moving through the supply chain.
Yes, that's right.
Yeah, and for us, Alphamundi, what we look at is what is the type of tech, because over the last couple of years, what we've seen in Kenya is tech being developed from the boardroom and then being implemented to the users. And what we've seen with that is that the probability of that working it's low, because you're trying to force the end users or your customers to use something which maybe you've not researched on. And the combination of the bottom up, whereby you go to the market to identify what is the issue, and then you come up with a product which is tech enabled. And then based on the information which is gathered from the product which you've deployed in the market, you'll be able to improve the product, and also you'll be in a position to come up with technology which makes the process efficient, as opposed to coming up with a tech which requires a change of behavior of the customers or the end users. An example which I could put right there is if you come up with maybe a solar pump which requires the farmer to capture data on a daily basis, you're not likely to get the benefits of that type of tech. But if you come up with a solar solar pump which captures the information like how much water was pumped today, how was power utilized? Was it utilized for pumping water for drip irrigation, or was it utilized for to watch a TV? Then you're able to get better information because it's not dependent on the user. So coming up with a product which is tech smart without necessarily the input of the end user enables improvement of technology, and it also enables getting information which is accurate, because as you know in tech, if you have bad information, then it will not help you the usage or even to improve the product.
Great, thank you, David.
Martin, if I can
Yes, Roger, go ahead.
elaborate and tie together some of the comments that my colleagues have made, there's a critical emphasis on appropriate technology. If you're using a hoe, a two-wheel tractor is advanced technology. And then even more advanced technology becomes a tractor with four wheels. So when we think about tech, we have to think about it in the context of what are the basic problems we're trying to solve and what is appropriate technology. David made some terrific points around data and the use of data for irrigation versus the equivalent of consumer use. But it starts with what's the right technology solution for whatever the problem is we're trying to address.
Of course. Of course. And just, I guess, from all of your kind of investor and funder lenses, right, kind of how does that factor into making decisions? And we could get a little bit deeper into this, you know, when each of you has an opportunity to speak about your firms, but just on a high level, Roger and David, based on what you were pointing out, how does that kind of decision making around, you know, the need for technology kind of affect how you look at, you know, your underlying organizations or companies or businesses?
Just to start, I don't think of it so much as the technology. It's driven by solving a problem. So what's the best problem-solving solution? And hopefully it'll be technology, but if it's not, what's the problem we're trying to solve and who's going to pay for it? You know, I know it was mentioned in the earlier session, too many people fall in love with the product, but they don't recognize that somebody has to pay for it. So I like to work backwards from the user, from the proof of concept, who's going to pay for the solution that we're trying to address, and is it a cost-effective solution for the user?
Yeah, for us, how that determines how we make decisions is we don't invest in the tech, we invest in the business model and then utilization of the tech to make the business model efficient and effective. Most of the time when we approach the tech, then you find that it might be something which is exciting, something which is exciting to the market, but something which cannot be applied in the market depending on the people you are targeting.
Great. So it does very much sound like it is very much about addressing the problem, right, as opposed to going straight to the technology component, right? How can it make it more efficient, and is it actually addressing the problem? That's great. You know, I think it's great to look at the bigger picture, and I think we're already kind of, you know, getting into bits and grabs, you know, how you guys think through your businesses and your companies. But David, Roger, Mezuo, you know, I'm sure folks are eager to learn more about your firms. So it would be great to hear, you know, one, a little bit of background on yourselves, and then two, how you view, you know, AgTech companies in your portfolios, including, you know, what kind of capital you have available, what types of companies or projects you're looking for, and ultimately what kind of investment criteria do you look at when evaluating these opportunities. So I'll go ahead and introduce our first investor, David Maina, who's an executive director at Alphamundi Group in Kenya. Welcome, David.
Thank you. So we've been operating in this market for the last 8 years. We also invest in Latin America. We are impact fund managers. And at the moment, what we have two vehicles. We have a debt vehicle and we have a hybrid vehicle in equity, mezzanine, and the convertible instruments. We look at a ticket size from $500,000 US, and we can go up to $2 million. and up to 5 million, including co-investors. We mainly focus on companies which are on the growth stage, and for us, growth stage is the companies which have been in operation for a minimum period of 3 years, and then with the revenues above 1 million, but you can consider below 1 million, depending on the value proposition of the company. We invest in mainly 2 sectors, renewable energy and agribusiness, farm to, and for agribusiness is farm to fork. So we take the value chain approach, and we like investing in companies where impact is entrenched in the business model. And by impact is what are you doing to the environment? What are you doing to the users, to the end users of the product, or to the suppliers? And then we look at companies which there's good corporate governance. Of course, we look at companies which have a good organizational structure with employees above 10 in number. And our approach is that we like growing with the company, so we can start with the small tickets and continue continue the follow-on, whereby we provide mainly cash for working capital, and to grow the business. Our investment criteria, it's the usual process whereby we need to go to the investment committee, and our period is 3 to 6 months, depending on the complexity of the business or the transaction, and depending on the instruments. We can invest in Africa. Currently, we are focusing more on East Africa, but we are looking for opportunities in South Africa and West Africa.
Great, thank you very much for all that context on Alphamundi, David. Very much appreciated. The next investor is Roger Frank, a managing director at Innovare Advisors in the US. Welcome, Roger. Roger, your mic isn't working again, unfortunately.
This is better. Thanks, Martin.
There we go.
While Innovare Advisors is based in the US, we have local entities in both Ghana and Kenya. And as was brought out in our earlier plenary session, you absolutely need boots on the ground. And our business model is fairly simple and straightforward. We provide lease financing for agricultural equipment that otherwise couldn't be affordable. So the entrepreneurs that we look to back, given where we are in our life cycle, have customers, period. You've got to start with the end users. Secondly, they need a good team around them. We've seen the challenges in Africa of solo entrepreneurs, and it's not just Africa. So the questions we begin to ask are really, who are the team? 3 is, what's the market size? If you're in a commodity, maize, for example, it's a bit of a me too versus something like ginger, as an example, where we're talking to an entrepreneur who's exporting or starting to export ginger, where there's a lot more value add. So our focus is primarily entrepreneur driven with some of those basic criteria around what we've just described. I've done some sort of capital raising and advisory work as well, and many of the criteria that I just mentioned are around the same thing. What's the product? Is it appropriate? Who's going to pay for it? And what's the market size? Let me stop there. Thanks, Martin.
Great, thank you very much, Roger. In that case, our final investor for this first group is Mezuo Nwuneli, a managing partner at Sahel Capital Agribusiness Managers in Nigeria. Welcome, Mezuo.
Thanks, Martin. We've been active in the sector the past 10 years. Root started out as entrepreneur, co-founded a food processing company, which we then built, did a private placement, brought in a third-party team. That company exports, sells B2B, and sells retail across the region. Then also built a ag consulting firm, which now runs independently with his own team and his own group out of 2 offices in Nigeria. And from that company, another group called Nourishing Africa was also spun out. And Nourishing Africa, for those that have not yet been to it, it's a hub where you can get quite a lot of good ag data on the continent. Where I've spent most of my time the last 5-6 years is on the private equity side. manage a growth capital food and ag firm. We have roughly 7 companies in our portfolio, everything from integrated rice to dairy to poultry to shea export packaging materials. So companies that have anywhere from $1 million to $50 million in revenue. And we do minority and majority positions. Probably what separates us from many other food and ag firms is that we have a very strong ops team of people that have actually run and built food and ag companies before. So when we engage with companies, a lot of value add, real world experience that we can bring as we engage with the entrepreneurs and the boards of the companies. We also have a TA facility, a technical assistance facility, where which can provide grant money for capacity building, outgrower schemes, whatever else is needed to provide support to the company. In terms of what we look for, what is key to us is local supply chain. So companies that have, of course, good management, but core local supply chain and for selling into domestic and regional markets. And I think the reason that's important for us is, outside of trying to generate commercial return, we're also trying to address food scarcity issues within the region, and building a robust local supply chain and selling to that market is pretty important to enable us to achieve that. I think from a tech perspective, I mentioned earlier, it's quite a bit of inefficiencies in the market, everything from crop yields to appropriate input use to the whole logistics of getting product and food to market. So we're very attentive to how we can address some of these things. And I think one other thing I'll touch on, or one last thing, is even looking at issues around insurance. So for example, in many markets, Nigeria especially, there isn't appropriate insurance that for many firms to use. And you may not view this as technology, or many people may not view this as technology, but using or being able to develop yield-based insurance products tied to data being aggregated from across different regions, so you can price insurance products properly to address different hazards within your particular regional field is important. And we've partnered with a few groups to do that in one of our operations where we have a large-scale commercial farm. I'll pause there, but I think key for us is local supply chain, targeting domestic markets. And we have a very strong ops team with deep food and ag experience we can bring to bear with companies we engage with.
Great, thank you very much, Mezuo. Do have, I think, one question on the chat, but before we go there, do just want to ask the three of you, in terms of your pipeline, how do you often go about identifying the businesses and the companies you ultimately work with?
So do you mean how we build pipeline? Sorry, Roger,
Yes, in terms of, Roger, I think you're on mute again. Roger, we can't hear you, unfortunately. A little technology problem.
Yeah.
We're all used to it by now.
David, why don't you start? I'll try to solve the problem. Is that better?
Yes, that is, Roger. We can hear you.
Good. It's networking. There's no shortcut. Once we tell people the problem we're solving, which is access to equipment finance, it's amazing how quickly people raise their hand and say, that's one of our challenges. So it's not very complicated, Martin. It's just getting the word out there, meeting a lot of people. We've got great local teams in both Kenya and Ghana. And despite the lockdown, they're very busily knocking on doors and networking, but we're seeing an extraordinary amount of demand because banks are lending, the system is being frozen, there's a need to increase production to improve productivity, and lack of capital for equipment is one of the real catalysts that's really holding back productivity.
Yeah, for us, maybe saying the same thing in a different way, we believe in partnerships, and we believe that we believe in co-investments. We believe in sharing what is happening in the industry. And that way, we get to make many friends. To us, at the moment, we don't have competitors because I think the market is huge enough, and the bigger the impact, the better. The more the players, the better, because also that enables the companies to, or rather the promoters, to come up with the tech which are solving real problems in the industry. And of course, also attending some of these conferences. This is one of the places where we get connections, which then can move on to the next stages of the pipeline development.
Great. Thank you very much, Roger and David. So I will address just two questions that were raised on the chat. The first one comes from Mahesh, and this is to the broad group. Do IP rights and protection of IP rights play a key role in AgTech funding decisions? How do you deal with this in the African context where the protection mechanisms are not sufficiently developed?
Terrific question, and it's an open one. First, the question is, who owns the data? If a farmer is on a platform, does the farmer own their personal data? Does the platform own the data? Does the telco provider own the data? I don't think there's a lot of legal precedent around this, and I think some of the models that have already been established in the more developed markets are the ones which ultimately will apply in Africa. But it's still a bit of a Wild West when it comes to proprietary data and data ownership.
I think also I can respond to that in terms of the first thing which we'll do is identify the proper way of ensuring that the IP rights are protected in the different countries which have that in place. And then the second part is if one is worried about the IP rights, then there might be a worry about the deprecation of the technology. And if there's worry on the side of deprecation of the technology, then there might be an issue of the unique selling proposition. And the way technology is built is that after a period of 2 to 5 years, there's likely to be deprecation from different areas. Could be from China, could be from even local people coming up with a better way of doing the same thing. So I would look at it more from the market. Is whatever the IP right being protected, what does it do to the market? Is it something which we are going to have the first mover advantage, and then we'll have a captive market? So there are different ways of looking at it, but the key thing is, of course, if someone has come up with something unique, they should also have the laws of different regions on whether they can protect it or not, and then from there move to market, and also look for investors to ensure that they have the first mover advantage.
Thank you, David. In that case, there's one more question on the chat, and I think it definitely is an important one. So Miles asks, how many of you focus on growth stage? Can you recommend sources of seed funding or for early stage startups? We've looked at GIF and Div. Any others from your perspectives? And just layering on, a few different perspectives from my experiences, just seeing investors, right, along the different growth stages, often working together to help graduate these companies, either in terms of kind of reinvestment or connecting with other investors that can support them as they grow. Any kind of thoughts or perspectives to Miles's question?
Miles, it's a great question, and it's probably the toughest part of the capital cycle. In VC terms, it's known as the valley of death. Sadly, there are not a lot of investors that are comfortable with that early stage. Increasingly, you're finding some family offices, you're finding some foundations that are very focused in on this, but it's really the realm of the impact investor where you can take an idea which might be 60 or 70% baked, not necessarily clearly identified on who the customer is. But sadly, if you begin to look at sort of the venture capital funding and the private equity funding, it's really all in the A, B, C stages, et cetera. Very, very little of it is in the early stage. So you're raising a great question, and unfortunately, I think it's a challenge for any early stage company.
Yeah, it's a tough one to. I think what I'll suggest as well is pay attention to the potential grant funding and TA that may be out there, because there are some development agencies that will provide some small amounts of capital to help prove idea or to earlier stage companies. So small amounts of money, if there's an impact related opportunity, then it's something to consider and look at as well.
And Mezuo, just to follow up on that, do you often work with those kind of funders, right, to source some of the pipeline that we were discussing, or to de-risk some of your investments during the later stages of growth?
I think, well, if you're referring to it as pipeline, that pipeline of companies we're looking at, we're always open to looking at opportunities, regardless of where they come from. But I wouldn't necessarily view it as a de-risk mechanism. It's more, at the end of the day, we'll make our own assessment. But I think it's capital available for earlier stage companies to allow them to scale, maybe prove business ideas, and then hopefully get to the point where they're more attractive to a later stage investor. But your specific question, we have engaged with and worked with different donor funders to look at opportunities. We have also looked at other PE co-investors. We've not yet pulled the trigger on opportunities that have come through that pipeline.
I think also to contribute to Miles' question, I've seen there are quite a number of accelerators who have come up, and they tend to provide some seed financing to, if they like the model, the business model. Second thing is we also work with the early stage support system, because that's the source of our pipeline. And what we do is indicate what we'd be looking at for us to invest in such companies. The only thing is the entrepreneurs who are focusing on accelerators need to be careful not to be going to one accelerator after another, because then that's changes of the investors.
Great, thank you, Mezuo and David. We have time for one more question before we move on over to our second group of investors. And this one comes from Anne. What are your views on data monetization by AgTech companies as an exit value proposition?
Question. It's optionality. I mean, I wouldn't dare build an Excel spreadsheet to show the value of the data, but if there's a core business that additional revenues can come from data monetization, then it's interesting. But it's still early days and we don't know the value of the data yet.
Yeah, I think information is power, and it depends on how that information is going to be utilized. Is it going to be utilized to come up with a new product, to go to new markets? Nonetheless, I agree with the Ronja that it should not be the basis of investing at this point in time, because we are yet to see how that is going to pan out in most of the companies which are gathering data, which have been gathering data for the last 2 to 3 years.
Great. Again, David, Roger, Mezuo, thank you so much for your time today, recognizing everybody has their busy schedules. Unfortunately, we do have a limited time for additional questions, so encourage any other participants to reach out to Roger, David, and Mezuo through the networking event after this session. Otherwise, feel free to connect with them directly. But again, thank you very much, you three. As we transition to our second group of investors, kindly now ask Gerhard, Brian, and Sarah to join the session as speakers, and very much appreciate everyone's patience as we quickly transition groups. Thank you. Great. In that case, Brian, Gerhard, Sarah, can you hear me?
Yeah, we can hear you.
Yes, Martin.
Yes, we can.
Great to hear. So that transition was quite quick. Looks like everybody has gotten quite proficient with technology these days in the time of COVID. Great. In that case, we can get very much straight into the content without all the introduction from before. Again, through the same process, I think just starting with some broader, perspectives and trends from your investor lenses on the AgTech space, writ large, and then transitioning into a little bit bigger insights in terms of how your firms view AgTech opportunities. But Brian, Gerhard, Sarah, any kind of broad picture perspectives from the investor lens that you can speak to?
Sure. I mean, I can start if that's okay. We at Zebu Investment Partners look at it from a very big picture. Then we narrow it to why the AgTech, investment thesis. If you look at Africa, Africa will have to feed the rest of the world or some parts of the world sometime in the future. And this is based on just the available land, for cultivation and other stats, water bodies, etc., that we have in the rest of the world. But before Africa could feed the rest of the world, it has to feed itself. It has to eradicate poverty. It has to ensure its food security. And if you also pay attention to Africa Development Bank, FAO stats, it currently employs 51% in the agri space. There's quite rapid urbanization. I think we are probably 55 to 60% urbanization right now. You have about $50 billion worth of food imported onto the continent. And the reasons these things are happening is just because we haven't really, we as those on the continent from Algeria to Zimbabwe, haven't really adopted the right set of AgTech to enhance food use, to be able to feed itself, as well as to be able to export excess. And economic system needs to also come up to support, the investment of AgTech to fast track, efficiently delivery of food from the farm to tables, as well as minimize the impact of food waste in the system. And over the course of the years since we started Zebu in 2012, we've been looking for solutions, that could solve some of these, which include access to market solutions. So you can think through that in the forms of traceability, digital platforms, financing for farmers, different, kind of innovative solutions that could enhance the use for food, as well as provide good, credible trading platforms for farmers to access, as well as consumers to be able to also tap into, to be able to improve food nutrition to families, and then have accessibility that will enable people to store food for a longer time and minimize the impact of wastage. And so, on the majority, you see a lot of payment systems coming on board, which may not necessarily be designed for agriculture players or players in the agri-food value chain alone. It may be designed for the economy, but then farmers can onboard, traders can onboard, input suppliers can onboard, and then it becomes a meaningful way of implementing, the trends in AgTech. You see, I think Roger came on board to talk about financing for equipment. So those are mechanized technologies that are still lacking in farming systems. And if we solve those non-digital type of technology gaps, then we could sort of merge that with the trends on payment platforms, what we call digital infrastructure, companies to be able to aggregate, buy from farmers when at harvest time, and then find the right set of consumers to sort of sell to. So over the past few years, from inception, we invested in very smart agriculture intelligent company that made sure that crop systems, water, as well as the right seeds were were matched with the right soil in South Africa. And that was in our first fund. And then in fund 2, we're looking at businesses that could improve traceability to sort of present integrity of input supplies to farmers, provide them with access to financing, as well as make sure that consumers or off-takers know the source of yields or crop outputs that they are buying from. So that would be my initial take on the trends that we've seen.
Mm-hmm. And yeah, I'd like to just build on what Brian is saying. I think in Africa and sub-Saharan Africa, we really are fixing gaps of broken value chains in the agricultural value chain. So I think that what we see as investors is really entrepreneurs and founders that are looking to fix those gaps initially, and then layering technology in a manner to make it more efficient. And not forgetting the reality of where we are today, which is with COVID, which has brought some glare. I mean, it's just really shone a light into those gaps. I think one of the trends we hope to see more of is there's an opportunity today to strengthen the local production and value creation. For instance, with inputs that Brian mentioned, the broken value chain, and mostly our inputs are imported. This has become quite glaring with COVID, and even more so for East Africa with the locust invasion, where we now are not even able to manage the invasion, because we don't have enough pesticides, for instance, to be able to manage it. So I think what we should start to see more is a boost to local production of biocontrol, biofertilizers, biostimulants, which would be crucial inputs into the ag value chain. And then on top of that, to layer technology in a way that allows farmers to optimize these inputs. And for this, you could consider precision ag solutions, remote monitoring solutions that are able to improve yields as well on the farm. Again, just on this import substitution point, there's aquaculture as an agricultural segment, where again there's an urgent need to fill the supply gap, where imports have been strongly halted now with COVID. I don't know how many of you know that most of the fish that we've been eating, tilapia, for instance, in East Africa, has mostly come out of China, and today there's a 70 to 90% drop in imports from China since the beginning of the crisis. Again, that shows a glaring gap just in production, in fish production locally. And then also customers are increasingly aware of food safety as well. So this has to be built into this. And then when you look at that, then you have to look at just the vertical integration towards local good quality produce as well, and looking at the entire value. I think Mezuo mentioned this in the first segment, is looking at logistics. Brian also mentioned this in just looking at how do you get produce from the farms to the table. One quite trend that has been quite immediate because of COVID is just an adaptation to consumer habits and how people are actually getting the food to their tables. We as Creadev, for instance, are invested in Twiga, and one immediate initiative they locked in because of COVID was a partnership with Jumia Foods, for instance, to deliver just standardized baskets of fresh fruits and vegetables directly to the home in a way that it's even cheaper than supermarkets, for instance. So just really starting to close the gaps in the value chain efficiently and in a way that is going to be affordable to the end consumer. These are trends that we are seeing, and we hope to continue to see really as ag investors.
Martin, to add to my colleague's points, from a big picture, McKinsey says that agriculture is the leading industry in the world. And from our view at AgVentures, we see that we are at the early stages of a revolution in agriculture. Now, innovation has been around in agriculture since the dawn of man, from the wheel to tractors and new seed varieties and so forth. But we are now at the early stages of the digitization of agriculture that's driven by by foundational or enabling technologies that is making agri-tech solutions affordable. And those enabling technologies are things like cloud computing, that's democratizing, data storage, data science, mobile connectivity through cell phones and smartphones and the like, and also remote sensing, whether it's drones or in-field sensing, robotics, etc. Another trend that we are seeing that's quite interesting, we invest in agri-food-tech companies at this stage, South Africa, Kenya, and Israel. And those three countries are at vastly different areas or times of development in their agricultural sectors. So if we leave Israel for now, I think South Africa and Kenya, South Africa is more commercial scale farming and Kenya's more small scale farming at this stage, although it is changing slowly but surely. On this commercial scale farmer side, we're seeing agri-tech solutions that mostly revolves around connected devices and data analytics. The connected devices, they gather data, whether it's drones, robots, sensors, smartphones, tablets, and that data goes to the cloud and the data is analyzed, which enables the farmers to make better decisions. So that's what we're seeing on the commercial scale. On the small scale, we're seeing that the ecosystem has not been fully developed yet. So the small scale farmers have a desire to be connected, whether it's to data, to financial services like funding or insurance, to input providers, markets, and also to logistics providers. So I think it's important to bear in mind that different sections of the agriculture, we're seeing different solutions and different opportunities. Of course, also touching on COVID-19, quite an interesting development that we've seen recently in South Africa is that recently they held online auctions of livestock, and a Nguni bull was sold at a record price for 310,000 Rand, which is the highest price in 15 years. Now, interesting enough, you would think a very high-tech platform was used to do that. It was actually done on WhatsApp, on a WhatsApp group, an online auction on a WhatsApp group. So it's also a bit of a reality check to AgTech entrepreneurs as to what they should and could be seeing as potential competition, especially if you look at adoption and pricing and the like.
Absolutely, Gerhard. And I think that also links to something that Roger was alluding to, which is, focusing on the problem as opposed to, digitizing a solution without kind of a clear problem, right? So very much agree. Great, Brian, Gerhard, Sarah, thank you so much. I think now, again, the group would be very much intrigued to hear, a little bit of background on yourselves, and then again, how your firms view these ag tech opportunities that we've been speaking about in your portfolios. So again, what kind of capital is available, what kinds of companies and businesses do you focus on, and ultimately what kind of investment criteria do you look at when evaluating these opportunities? I'll go ahead and get started with our first investor, Gerhard Visagie, who is an executive director at AgVentures in South Africa. Welcome, Gerhard.
Thank you, Martin. So maybe a bit of personal background. I've been in early stage agri-food investing for the last decade. For the first 5 years, a dedicated agri-food private equity fund, and then we launched a corporate, which we build up through mergers and acquisitions over the next 4 odd years. Market cap of around about $250 million, 15 companies. Looking back, our most successful investment to date was our first one in 2010, 2011, which was a food tech company. And a lot of lessons were learned from that experience, sitting on the board for a decade of a company that grew tremendously fast and also thinking deeply about where the industry is going and where the opportunities are. Just more on AgVentures, our purpose is to unlock the potential, the agri-food potential of Africa through investing in disruptive, innovative agri-food technologies, very much to the reasons that Brian spoke of. You know, everybody reads about the tremendous potential of Africa, but why is it so slowly realizing? And we truly believe that there are innovative technologies that can fast track and even leapfrog the current problems that we are seeing. We also assist our companies to expand their offerings into the rest of Africa. And our first investment was in a Israeli agri-tech company called FruitSpec. They provide early crop estimates for fruit farmers 4 to 6 months before the crop. We are yet to find a competing offering that can be so accurate at such an early stage of the season compared to them. And as I mentioned, we focus on 3 countries: South Africa, Kenya, and Israel. South Africa more commercial scale, Kenya more small scale, and Israel is just such an agri-tech powerhouse. And we're seeing so many solutions that they develop there, but their own market is not big enough, or it's not applicable to their market. So we are building a bridge between Africa and Israel as well, bringing those disruptive tech to Africa. We generally invest between 500,000 US and 3 million US. We're comfortable to take a minority stake, preferably a board seat as well, so that we can assist the companies on a more hands-on basis to get their strategy and their house in order. The type of companies that we're looking at is owner-managed. We need to have the technological proof of concept established, and they should be revenue generating, although not yet necessarily profitable. Because why we're saying revenue generating, we're actually seeing quite a few AgTech solutions, as also mentioned by my colleagues earlier, that that's been built in a boardroom and not on the farm. So it's actually it ticks quite a fundamental box when you see that this solution is generating revenue and have customers, paying customers. Then also the technology has to be unique. It doesn't have to be patented necessarily, but it has to be unique and defensible in different ways. I think in certain aspects it's actually counterproductive to patent certain technologies. Sometimes it's just better to keep it a secret. And the type of technologies is very broad, from digital platforms to farm management software, agricultural biotechnology. We're spending a lot of time on innovative irrigation solutions and software, because we think through climate change, it's just becoming so much more important to manage that scarce resource, which is water. And then also sensors, sustainable packaging. You know, I was on an African island not so many months ago for honeymoon, and you know, it was interesting to see all the plastic floating around on the most idyllic beaches, and it just made me realize again how we need to transition away from single-use plastic to something that is more sustainable, like compostable packaging or recyclable packaging or the like.
Great, Gerhard. Thank you so much for all those very useful perspectives, and congratulations on the wedding and honeymoon.
Thank you.
Great. So our next investor is Brian Frimpong, a managing partner at Zebu Investment Partners in Ghana. Welcome, Brian.
Yeah, thank you very much, Martin. Zebu is, we use the private equity model to invest across the agriculture value chain. It's a Pan-African fund, so we're focused on sub-Saharan Africa. We've done 10 countries so far, and we invest between $2 to $8 million the transaction. And since we're an impact fund too, we look for certain outcomes, not just the economic returns, but we look to be able to make sure that the ecosystems in which we deploy capital to is sort of properly aligned with the business in which we invest in. So as a result, the investments typically come with a technical assistance facility that looks to enhance those ecosystems in which we deploy capital in. Most of the time, for us, we want companies that, just similar to Gerhard's, we want companies that have at least a 3-year track record of management teams working together to be able to come up with an output or something that we know for sure that on a post-investment basis we can count on them to grow sustainably, since it's mostly a growth capital investor. But from the AgTech perspective, we've looked at slightly early stage businesses with proof of concept, where the founder, the owner of the technology, has sort of stuck around to make sure that it kind of comes together. And then similarly, from an AgTech perspective, there are certain countries that you could clearly see that the regulation is supportive of technology growth or AgTech growth. So we're much more comfortable in countries such as South Africa, Kenya. We're looking at platforms from those economies. We're also looking at Nigeria because there's quite some transformation when it comes to new businesses starting there. So we're hoping that from an incubation perspective, over the next 3 years, some of them will get to a point where the need for series of funding would require funds like us to participate in to make sure that we take them to a certain level, and that allows them to scale beyond even their local economies, because AgTech is, in itself is the language alone. If the regulation is permissible enough, it can allow you to sort of play between francophone and anglophone countries and russophone countries. So far, we've done 2 investments from 2 different funds. So our first investment was in Smart Intelligent Ag. That was a company based out of South Africa, under Avison, where it was mostly precision planting, precision sort of agriculture. So the whole idea concept was to make sure that there was efficient water supply. The intelligence allowed us to be able to improve the yields for clients, allowed us to gather data that was meaningful in communities in certain parts of South Africa, and it did decently well. We're currently in talks to also invest in a company that provides traceability and a good platform for farmers within different sort of subsectors, different crop outputs, to be able to track information, aggregate them to access financing. Because if you have the data on the farmer, you can figure out how to help the farmer in terms of what are the right inputs they need, what kind of seeds quality they would enhance their outputs, as well as be able to time or properly structure the level of financing that they need when it comes to planting, developing the farms all the way through harvesting. So hopefully.
Brian, you did cut out there for one moment. Give you 1 second to see if it reconnects. Okay, well, in the spirit of time, recognizing that we are over, we should probably move on to our final investor for the day, who is Sarah Ngamau, a managing director at Creadev in Kenya. Welcome, Sarah.
Thank you, Martin. And Creadev is by introduction, it's the investment arm of a family, a retail entrepreneurial family from France, which is a 6th generation today. And they've really grown to build a very large network of retail companies globally, and grew by basically supporting entrepreneurs within the family. And in 2002 decided to extend the concept beyond the family and beyond retail by starting Creadev. And so Creadev basically is, we have offices in Paris, in New York, in China, and then in Nairobi. For the Africa side of things, we look at just investing in innovative solutions that are providing access to essential goods and services to the many. And innovation for us here is not necessarily, high tech. It's really just, it's mostly in the business model, similar to, I think, what David mentioned. We look at the business models and we look at, new ways to meet unmet demands, which are many in Africa. And we look at essential goods and services. Here we look at food and health and education. And so on top of food and AgTech, we also look at health and education. And then to the many, really we're looking at how do you get these essential goods and services to growing populations. We heard the numbers from Brian. Africa is growing fast. We'll have 2 billion people in sub-Saharan Africa by 2050. There's rapid urbanization. There's a rising middle class. How do we meet the needs of this growing population? And this is really the segment that Creadev focuses on. In terms of the criteria of companies that we look to invest in, we look at a combination of a proof of concept and what we call a scale engine. For us, the proof of concept is the product needs to work and needs to be proven. And for us, what we're really looking as a proof of concept is a proof of revenues. Can this product or service be distributed to customers that are willing to pay for it? And so we need to at least see a run rate of revenues of at least $1 million. And then the scale engine part of it, or what we call the scale engine, is the systems and the people that need to be in place for the business to become a champion in its market. And systems here, we're not saying you need to be 80, 100% having all the systems in place, because that's part of the value creation we also want to bring on board. We have, like I said, 6 generations worth of value creation and networks that we can leverage on for our entrepreneurs. And we look to be an active investor. So we look at supporting the entrepreneurs beyond the dollar by providing the synergies that this ecosystem that the family has built can bring, including the fact that we are multi-continent as well. We can take learnings from China, we can take learnings from the US, we can take learnings from Europe into our companies. In terms of ticket sizes, we do between $1 million and $10 million, and we like to remain above a 10% stake. So we can be a minority, but really we want to be a significant minority. We want to be able to have a board seat. We feel that the way that we can build the value for those companies is really being on the table and helping them to build this. Within AgTech space, the investments we've made, I think I mentioned one earlier, is in Twiga Foods, which is a business that does disintermediation and aggregation, really allowing produce to come from the farm to the market using technology. We also invested in urban farms in the US, which is something that, again, here we have to always look at context. This works in the US. They're looking at building farms on top of industrial buildings on rooftops, and that's working in the US. That's a company called Gotham Greens. We are also invested in a company called Hungry Harvest, again in the US, that's really looking at post-harvest wastage, how to take what you would call ugly fruit and ugly vegetables into the second market and being able to get it to the consumers and to the homes. In terms of the geography, for the Africa office, we're looking at sub-Saharan Africa. We, of course, have started with East Africa, and we look at Pan-African businesses or businesses with an ability to scale and become Pan-African. But we can also look at West Africa and Southern Africa as well.
Great, thank you very much, Sarah.
That's us in action.
And perhaps in the spirit of time, maybe I do feel just one question, and it is something, Gerhard, that you were alluding to, but open it up to the entire group. And this one comes from Greg. At least one of the questions he has is, what is your view on businesses that focus on commercial farming ag tech versus smallholder ag tech?
Yeah, I think to my earlier point, they are addressing different needs, and they have vastly different price points and affordability. So, but what we are definitely seeing is that, and I'm thinking of a couple of AgTech solutions that I've actually come across and spoken to founders over the last couple of months, where we are seeing technology that is enabling small-scale farmers to receive the same kind of technical, scientific advice that currently commercial-scale farmers are seeing due to a variety of reasons.
Yeah, I can chip in if that's okay. Just from a financing perspective and the likelihood of that catching wind, you will see most of the DFIs sort of willing to throw capital at businesses that finance smallholder AgTech. And to Gerhard's point, they both focus on different things, whereas there'll be more kind of commercial-oriented VCs that want to see these commercial farming AgTech solutions kind of come into play. And so depending on how scalable the model is, and depending on what kind of ecosystem that the AgTech wants to sort of build in the long term, there'll be two different kind of investor profiles that want to that want to pursue the two, just because much more impact on the smallholder AgTech platform, whereas the commercial at some point is expected to attract certain larger scale B2B, which, you know, it's missing in a lot of African economies. But then there's a drive to support that large scale commercial nucleus farm. So eventually that may too be successful independently if it gets the right set of investors to support it.
Agree, and I think I would add that there's a question of unit economics and the question of scalability as well. I think both of this can coexist together, even in the same business model. And I'll use the example of Trigger Foods that we are invested in. They did start off with smallholder farmers as the farmers that they were sourcing from, but then quickly realized that for the demand, the scale of the demand was so big that it requires to go further than a smallholder farmer, and it requires you to start to also incorporate commercial farms into it as well. So, I mean, it's possible for both to exist. It's always a question of what are the economics at each of those levels, at the smallholder level and at the commercial level.
Yeah, on a small scale level, what I'm seeing is that either the supply has to be unitized or the demand has to be aggregated. And just in
exactly
telling the listeners a couple of problems, difference between the problems or things that the commercial farmers are thinking as opposed to the small scale farmers. What we think, for instance, the commercial farmers, they want to know how big is the crop going to be in 4 or 6 months' time. They have to schedule labor, pack house capacity, logistics, all those kind of things. They are thinking, is it possible to buy a autonomous tractor or autonomous planter, because they have, you know, 2,000, 3,000 hectares that they want to plant, but they have the size for that. On the other hand, some of the problems that small-scale farmers are sitting that we've spoken with is, you know, they just want to know what type of soil do they have on their plot, and what is the best application of fertilizer, For a commercial farmer, they do it every year. It's a no-brainer. It's so part and parcel of their business model. But a small-scale farmer doesn't have cost-effective access to those basic kind of services, and that's what excites me, because I'm seeing solutions that are starting to address those problems by unitizing the supply, by making it more cost-effective. And a lot of the things is in-field. We're moving to in-field, from the lab to things happening in the field due to connected device and cloud analytics and those kind of things.
Great. Well, Sarah, Gerhard, Brian, thank you very much for all your very interesting perspectives. And I know that we can continue having this conversation and asking many more questions. And unfortunately, we did have a set time that we did ultimately go over, but did also want to thank David, Roger, and Mezuo as well for all of your time, just to hear about your perspectives and experiences, and hope some of the folks on the line appreciated those. So at this point, we will conclude this session, and we will take a 5-minute coffee break, which was originally scheduled. Although that being said, I would encourage everyone to enter the networking event, to connect with one another or to speak with some of our investors that were held within this session. But again, thank you very much to all our speakers, and wishing everyone a great day.